To kick off the week, let's talk about market technicals. Joining us is JPMorgan's head of technical strategy, Jason Hunter. And you look around, and I wouldn't say you're particularly in love with what's happening right now.
That's right, yeah.
Are you, Jason? And it has to do with what I couldn't understand is you do think maybe we'll orchestrate a soft landing, but in doing so, we'll start perceiving the recession risk as much higher than we do right now, and that will hurt stock prices?
Yeah, that's correct. Yes. Yeah, because when you look at the timing since curve inversion and go back into the 1960s and take yield curves that go back that far, as we move into next year, as that window continues to progress, you tend to find your way into a bear market that's eventually associated with a recession way more often than not. You know, the odds are stacked in favor of a hard landing, actually. Our house view is that we actually land in soft landing. But when you look at how markets are priced right now, they're very much priced for a soft landing. Between here and there, we have the unfortunate experience that we're going to have to go to stall speed. That's what enables the Fed to start easing in the second half of the year. And just that trajectory, the market's going to have a significant gut check of whether that inertia is going to carry to a recession or not.
It's pretty amazing because the market's so smart that you're forecasting maybe a slowdown on recession fears, but you're not forecasting a recession.
That's right. And then so there's always the uncertainty of whether that inertia carries as well. And the premium's just not in the market right now.
Good for bonds, though. Good for global bonds.
That's exactly right, yes. Yeah, the easy curve is yields lower, curve steeper in that year ahead outlook.
What's the Fed going to do in that environment? I mean, you're a technical analyst.
That's right, yeah.
So but what would, I mean, with that prediction, what do you think you would see end up with, to give you that outcome? What would the Fed be doing?
Well, with the JPMorgan view, the house view that Mike Feroli and the U.S. economics team have, as we get into the back half of the year, even with a soft landing outcome, the inflation expectations and that softness in the data that takes you there allows the Fed to start easing at an every meeting pace as we move into the back half of the year. And that's, again, with a soft landing outcome, not even a hard landing outcome.
And you don't check with Jamie Dimon on that, do you?
Oh, yeah, we talk within the research organization.
You talk within the research organization, because I'm not sure he would agree with that entirely. So there were a lot of really esoteric things in your note, too, about DM bonds. Is that developing market?
They're developed market bonds, so the U.S., Europe, yes.
And those are expected to benefit even more than stocks, in your view?
Yeah, so stocks should pull back. In my base case view on the technical side, I think the S&P is going to drop to 3,500, which is just a retest of the lows.
Whoa, wait a second. Hold on a second. Well, I guess we buried the lead. You think? Just say that again, slowly.
So a retest of the lows for 3,500.
We're at 4,500.
Yes, 20% down from current levels.
Oh my God! And so that starts till we get finished with the Santa Claus rally. Does this last a little longer?
Maybe a little bit longer, but it's already starting to decelerate to the point where our algorithmic-based signaling is already starting to show that you should be lightening up positions and starting to hedge at this point already.
I'll say I'm running for the hills. We don't do anything. So 4,600. It's starting already, but in earnest begins at the beginning of next year.
So if you look at stall speed hitting as early as the second quarter and into the third quarter, the markets, if given their typical leads and lags, should start to price that, the first quarter.
In January.
My base case view is 3,500 by mid-year, and then if the yield curve's steepening as we expect, the market makes its bottom and starts to price in the next cyclical advance.
Towards the end?
Let's call it mid-year, yeah.
That's down somewhere around
3,500 where it makes it slow.
3,500 where no one's expecting that. That would play into the secular trading range.
That's right. Yeah, we've been in a 3,500 to 4,800 range. That's right.
Yeah, that we're going to make no. And then when do we finally go to new highs? I mean, that's too far out for you, probably.
No, I mean, like if the curve's going to steepen and the Fed's going to be allowed to start easing in the second half of the year, we think about 2025 could actually be a positive year where you actually move on to new highs.
25 could be a positive year.
Yeah.
I think you mentioned in cyclicals, you've already seen them roll over.
Yeah, so if you look at cyclicals, have been under pressure since 2022, and they never really rebounded this year, even though the broad market lifted quite a lot. It's a very thin leadership, where if you look at your cyclicals, not only in U.S. equity markets, but around the globe, commodity markets, emerging markets, specifically when you get closer to those that are linked to Chinese growth, have been under enormous pressure this year and have really failed to lift. That really adds conviction to our view that this is still a late cycle environment. It's only thin leadership that's what you tend to see in a late cycle environment. And until the cyclicals start to perform, which we don't think will unfold until, let's call it the second quarter of 2024, that's when you start to get excited.
So if I believed you, and if I was wealthy, and if I was allowed to trade, I would sell, if I believed you, I'd sell all my equities right now. And what would you tell me to do?
Right now, cash is paying about 5%. It gives you the option to wait.
Don't go out, but you like duration.
So you can go long duration. I mean, if you go long, a 5-year
give me a
point.
whole, okay, so I put some in the 2-year?
Yeah, 2 to 5 year point on the curve is where
2 to 5 year.
Yeah.
100% I'm putting in the 2 to 5 year. Governments?
Yes, governments, yes. And that gives you the optionality. You're picking up yields. You wait for the equity market to pull back to attractive levels, and then you roll from your fixed income.
Can I put it all into Bitcoin if I prefer?
That's not a market I cover. I cover a lot of markets.
I can't do that.
Yeah,
so
crypto is not one of them.
2 to 5 year, 100% of my cash.
Yeah, yes, that's where I would be right now.
God.
You got it?
Pressing me, Jason.
Yeah,
we will writing. I won't forget, and you might be right, and then I'm gonna think you're like God if you write about this thing.
Or if you're wrong, he'll never let you forget.
Or if you're wrong,
exactly.
I'm gonna laugh at you and point and go nani nani nani.
Yes, I've been doing this a long time. I'm prepared for that outcome. Yeah.